Over the last few weeks, we've been speaking with investors and founders about the kinds of safeguards required to drive accountability at startups, especially at a time when reports of governance lapses, related party transactions, mis-selling and exaggerated metrics have been hitting the headlines. We've raised questions about the responsibility of the board, the need to prioritize good governance practices and value systems that can withstand the trials and tribulations of building a successful business that's growing at a breakneck speed. We've also raised questions on the role of the founder and his or her relationship with the investor. Well, being a startup founder is a hard job, and more so during difficult times. And therefore, today we want to focus on some other crucial aspects of the founder-investor relationship, that of communication, aligning expectations. While it is clear that there is need for constant dialogue between the founder and all stakeholders on the company's milestones, but more importantly, what shape does this conversation take when the startup is going through tough times, which are generally more than a few in a company's lifetime? How can or should the two align to negotiate the challenges faced by businesses? And how can open and timely communication with the board help startups cruise through rough waters? Hello and welcome to Young Turks, India's longest-running show on startups and entrepreneurship. I'm Bhal, and joining me today on the program, Abhiraj, Bhal, the co-founder of Urban Company. The firm has inducted 4 independent directors on its board this week with a commitment to take that to 50% of the board. Also with me, Ananth, Narayan, the founder of Mensa Brands, and Shanti, Mohan, the founder of investing platform Letsventure. Ananth, Abhiraj and Shanti, many thanks for joining us here on the program. Before we focus on course correction and where course correction needs to take place and the guardrails that need to be put in place, let's try and identify what the problem is, where the problems lie as of today. And let me bring up an interesting piece that's been written by Ananth of India Quotient on our sister publication moneycontrol.com. And Ananth's raising a couple of interesting issues. He believes that part of the problem that we are faced in India today is the fact that the focus has been on valuation as opposed to value creation. He believes that we've almost institutionalized hacking the next round of funding. Those are his words. And he says that's led to a systematic corruption of young founders. What he's also talking about is another interesting aspect. Given the kind of breakneck rise that we've seen, especially over the last 2 years, not just here in India, but globally as well, of digital startups, the fear of missing out, is that driving investors to ignore red flags and go ahead come what may? He also talks about the fact that in the race to touch valuations and emerge as the next unicorn, founders are diluting too much too quickly and thereby don't have enough control over their own businesses. Another important aspect that Ananth is raising, and this is something that Sanjeev Bikhchandani also raised on our program last week when we were speaking with him, was the focus on secondary sales. Sanjeev also believes that secondary sales should be few and far between. In fact, Ananth also believes that there should be restrictions on the number of secondaries that can be done. It should be restricted, is his point of view. So to sum it up, in a very comprehensive piece that Ananth has put out today, he identifies some of the problems that he believes are driving the governance lapses that we are seeing in the Indian startup ecosystem today. So Ananth, let me start by asking you, do you agree with that prognosis, with the diagnosis?
Look, it's a complex issue, and thanks for having me, Shri. So the first is, I think the focus should be on value creation, not on valuations. I think valuations are an outcome. And I do believe that fundamentally, people don't focus enough on ownership. This is my 3rd time. And I think it's important to, valuations go up and down. Your ownership is actually, by the way, once you've diluted, it never comes back. So I think focusing on value creation and letting valuation follow is absolutely the right thing, right? But the issue we're talking about a little bit is around corporate governance. So I would say 3 points from my side. One is, I think businesses need to be built on sustainable metrics. It doesn't mean you don't invest in growth, but there is healthy growth and unhealthy growth. So building a sustainable business needs to be the first focus for creating great corporate governance. The second is actually the practices of corporate governance. And here I would say making sure that there is constant communication with you and the board, giving the bad news up front, making sure, by the way, that there is an internal audit mechanism that reports to the board, making sure there are independent directors. There's a bunch of things that one can do. And I think the onus is both on the founder and the board to make that happen. And the last, maybe I wanted to talk a little bit about is values. And I think this often gets forgotten. I think values is what you do when nobody's looking. And therefore having a values-based culture, which we, for example, at Mensa have, right, we first defined our values early and upfront within the first sort of month of operation. And I think those will stand us in good stead. And I think making sure that that spreads across the organization means that as the organization scales, people make values-based decisions as opposed to not knowing what to do, because you can't actually monitor every decision at every level. So I think first create a sustainable business, which automatically takes care of valuation, ownership, all of that. Second, on corporate governance, make sure you share news fast and share bad news even faster with the board so that there are no surprises. And set in place things like internal audit, independent directors, etc. And third, really think about values-driven organization, because that's eventually values and ethics, more than governance and anything else, is really what actually will differentiate you in the long term, right? There are examples of companies in India, in the new generation, that have done it, whether it's the Infosys of the world or otherwise.
Yeah, Ananth, and I'll get Shanti to comment on that. And there's interesting aspects that you've brought into the conversation. But let's address the very first issue, that you need to focus on creating a sustainable business. But if we look at what's been happening around us, not just over the last few years, but more specifically over the last few years, the kind of money that's come into the startup ecosystem. And by the way, for most of the companies that have raised large funding rounds, there is no runway to profitability that has been provided by founders, and yet the money has come through. Yet investors have poured in money, which is also sort of given wings to the narrative that, look, it doesn't really matter if you continue to burn cash in the short term, medium term, or perhaps even the long term. There's somebody there who's willing to pay the tab, to pick up the tab on your behalf. Has that fueled this culture where metrics like growth and profitability are no longer metrics that deliver a premium?
So I think, look, I mean, Mensa has now been started. It's 1 year. We have not talked about GMV once. We talk about net revenue, we talk about EBITDA, and we talk about free cash flow, which are eventually the metrics that actually matter, right? So I think starting from day one and looking at that actually as an advantage. And by the way, most investors who actually, Shanti can comment, but most investors actually realize the value of a sustainable business. And I think there is a large push to creating sustainable businesses. So from day one, we talk about net revenue, EBITDA, and free cash flow. And I think that's incredibly important. And I think that's how businesses get built. Now, in some cases, I do think investing ahead makes sense, especially when businesses have a network effect, which is the largest player starts to attract a whole bunch of the traffic and the consumer internet traffic and so on. But even in those businesses, there are metrics that actually do matter, right? Customer stickiness matters. Lifetime value of the customer, the cost of customer acquisition matters, whether you're in content or otherwise. So I think sustainability doesn't always mean EBITDA and free cash flow. In our business in Mensa, it does. But even if not, there are a set of 2 or 3 metrics that will allow for sustainability. And focusing on that from early days is incredibly important, because then, by the way, once you're on the wrong treadmill, it's very hard to get off it. So the key is to set the expectations right from day one on the right treadmill. And then the faster you run, the more positive impact that you actually have. And that's what, at least at Mensa, we've been able to do, which really helps.
Shanti, let me address this issue with you. In your assessment, Shanti, as we look at the landscape today, do you believe that majority are on the wrong treadmill, and Ananth the exception and part of a very small group of founders who are actually focused on profitability, who are focused on building a sustainable business? And how important do you believe it is going to be, as we talk about course correction, for founders and investors to get on the right treadmill?
Yeah, thanks, Shireen, for having me. And while Letsventure looks at very early stage startups, I would not necessarily agree that a large percentage is on the wrong treadmill, right? Because at the early stage ecosystem, investors are investing their own capital. So they actually want to ensure that they are betting on the right founders. And one is, while we are betting on the right founders, they also have mechanisms of evaluations of the business. While I agree that there has been a very large narrative of a lot of capital coming into the Indian ecosystem, I think the early stage ecosystem still has a very different way of evaluating businesses, a very different way of evaluating founders. which basically could mean that at that stage, you may not have visibility into profitability, you may not have visibility into revenues. It may be more betting on the idea, more on the idea becoming a contrarian idea, right? So a lot of very different evaluation metrics comes into early stage. But in my kind of learning, I have seen that, maybe 75% of the investors are still looking at businesses which will eventually become sustainable over time, right? Which will create value over time. So I don't see that as a larger percentage of investors who are ignoring all those metrics, because finally it is their capital at stake, right? That is the first part of it.
Yeah.
And second, I think as young founders, what I have again seen at Letsventure, as well as I have seen in the early stage ecosystem, sometimes people are in a hurry to close their funding round, right? Which basically means they're like, can I get the cash in the bank in the next 15 days? And you cannot get the cash in the bank in the next 15 days if you don't have your due diligence done, if you don't have the basic governance structure set up in place, right? And I think as investors, what we should insist on is, getting the money maybe 15 days later is okay, as long as I know that the business I'm investing in is actually right on compliance, right on governance. And those are the early kind of messaging you send to the founders, that it's okay not to, it is not okay to have a business which does not focus on compliance and governance, right? So I think collectively as an ecosystem, we have to take a step back and say that, when I'm investing capital, can I ensure that the basic hygiene of the business is set up, right? Can I, as a founder, also take the accountability? And in my view, again, Shireen, at the end of the day, it comes to the intent of the founder. That is it, right? If the founder has the intent to build a strong business long term and is taking a 10-year view on his effort to build the business, he is going to get the right people, he is going to put the right structures in place. But the moment you want to become a unicorn in 3 years, then I think you're blitzscaling, and the cost of blitzscaling is going to be governance, is going to be lack of metrics, because businesses don't get built in 3 years, right?
I want to take that point across to Abhiraj, and exactly what Shanti was talking about, and Ananth mentioned that as well, building for the long term. And Abhiraj, thanks very much for joining us. You've decided to bring 4 independent directors on board, and you've also made a commitment that you will have at least 50% independent directors on your board. Now, what we have seen in the recent past is companies are setting themselves up for the public markets, are getting ready to IPO. A lot of these regulatory compliance-related issues are factored into the plans. And I would imagine that you're looking at an IPO at some stage. I don't know if this is necessarily linked to that, but explain to me why the decision to bring 4 independent directors on board at this time.
Thanks, Shireen, for having me. I think, Shireen, the decision to have 4 independent directors is predominantly to ensure that we have high corporate governance and the right advice and structures in place to guide the company for the next wave of growth and its next journey. I think in the first few years, when the company was young and still trying to find its feet, the board largely comprised of the founders and the investors, but we felt as a board that it was important that we get independent voices on the table. And I think it's well proven that in the long term, independent boards create far more value for all shareholders. At some stage, we will look to go public, but I think we wanted to do this much in advance of going public so that we have the opportunity to work deeply with these independent board members and create a cohesive working group.
But what I want to understand from you, Abhiraj, is, you've gone through some difficult times, especially in the past year or so, and this has all played itself out publicly. It's also played itself out in courts, and it continues to play itself out in courts. I want to understand what the dilemma was for you at that point in time in terms of both internal communication, external communication, communication with the board and investors. During the challenging times, how challenging is it to align expectations and ensure that everyone is on the same page?
I think, Shireen, building a company is challenging. So as a starting point, when you decide to do that as a founder, like you're signing up for a challenging journey, and there'll be ups and downs. I think as long as you're doing the things with the right intent, and you have your heart in the right place, and you know that you're doing the right thing in the long term, I think it makes things easier. So we've always focused on the long term. We've always focused on doing right by all our stakeholders. And it's not possible at all points in time to keep everybody happy. And honestly, that's not even the job. But the job is that in the long run, you are creating wealth for your shareholders, you are doing right by all your stakeholders, and that's what we've kept in mind. The decision to bring on board the 4 independent directors was also in line with that thought process. And it's not a straightforward process to find the right set of people. And we were very particular that we wanted extremely high quality individuals to join the board. So the process actually took us a little more than a year. And with some of these individuals, we've been having a relationship for several years now, where we've known them and sought their advice, like Irina Vittel, who's been an advisor to me and the company for the last few years. So I think it was a well thought through and long drawn out process in our case.
Ananth, I want to come back to something that Shanti said, and you brought up in your opening comments as well. The guiding principles need to be the 4 Ps in Shanti's words: people, process, purpose, and performance. And that's pretty much what you echoed as well, Ananth. And you talked about the mission statement that you laid out for Mensa pretty much from day one when you got things off the ground. Now, how important is it to have that dialogue with investors? You're acquiring companies. You've now got 20 plus companies under Mensa brands, to ensure that the same set of values is then transferred on to the people that you work with, your other stakeholders. Explain to me how you've ensured that there is an alignment of expectations, because a lot of the conflict that we see arising today is on account of the fact that the founder and investor relationship in many cases is broken.
Right. So I'll talk about founder-investor relationships first. So I don't think there are easy answers, Shireen, but on the founder-investor, one of the things that I've found is from day zero, just being transparent. So I still, by the way, it's now 52 weeks. I send out a weekly top of mind that goes to everybody at Mensa, including all the investors, right? We have what started as a bi-weekly, but now monthly sort of MIS deep review with our board, right? We have a board meeting that actually, you send material well in advance. And my big belief is share the bad news faster than sharing the good news. The good news always gets to people. So I think constant communication, in fact, over communication, I think with investors and with all stakeholders, quite honestly, I think really helps. And with the principle that, share the bad news faster than the good news, because the good news will reach me. I think that's because, when you're building a company, like Abhiraj said, right, there is always its difficult times and then good times, and it's a cycle. So doing that, I think, really helps. I think that's number one. The second question is one of vision and values. And I think being clear about your vision and what you're trying to build instills a little bit of long-termism. So I want to use another analogy. I think, a little bit of running a startup is like having a telescope in one eye and a microscope in another eye. And I think you need to do both, and sometimes it gives you a headache. But the telescope is actually, you have a constant North Star, and you have a vision of where you want to go. You want to be a profitable tech-led house of brands, and global in our case. The microscope is you have to manage this quarter's performance, both on growth and profitability. And you have to constantly look at both things, right? And I think if you do, it's tough to do, and you don't always get it right, but you at least have a perspective of doing it. And the values point of it, Shireen, is very simple. I think values are literally sort of talking about them, celebrating good values, and I think having a zero tolerance for bad behavior, I think really matters. We have passed deals many times when we have found, by the way, that there are issues when we have found diligence. The numbers look great, but there were diligence issues that came up, and we passed those assets. And I think that's actually, by the way, the right thing to do if you're trying to build something for the long term, as opposed to trying to optimize for the next quarter's fundraise, the next quarter's revenue, or whatever else, right? So making sure you have a long-term view, make sure that makes it easier for you to make the tougher decisions in the short term.
Yeah, well, Abhiraj, I want to understand from you how you're balancing the telescope and the microscope, and that's an interesting analogy that Ananth has put on the table. And what are the processes that you've put in place at Urban Company to ensure that you do have the guardrails? Because, you know, compliance is one thing, governance is another matter altogether. In many cases, and I'm talking about large listed entities that have gone through significant challenges, I mean, they've met all the compliance requirements as part of the listing agreement and the listing arrangements, but they've still had massive accidents and massive blowouts. So compliance and governance may not necessarily converge.
Shreen, I think, as Ananth said, I think it starts with the values. You've got to have very, very clear long-term values and a zero tolerance policy to any deviance from that values. But I think post that, it's also important to put in place the right set of processes, the right set of tools, and the right set of rigor to ensure that you're on the right track. It always starts with the board, then it moves to the executive team, and over time it moves to all the other teams. As you scale, you want to ensure that teams are empowered, that teams can move fast and execute fast. But you want to balance that rapid execution and that freedom with the right set of processes and the right set of guardrails. And sometimes this means that you need to be a little bit slower in the short term to have more velocity in the long term. And as we've grown and as we've matured, we've ensured that we've put in place those processes, whether it's around risk management, whether it's around data protection and privacy, whether it's around finances and financial management, etc. It's also important to ensure you work with the best external stakeholders who will really help you. And the big four and the big five are typically very helpful in this, but beyond them as well today, you have some of the best experts who are available, whether it's legal, whether it's data compliance, to just make sure that from time to time, you are trusting, but also verifying all your processes. And I think that trust but verify approach is critical and the bedrock of good corporate governance, in my opinion.
Shanti, I want to come to you as well with the key guardrails that you believe, especially as you're starting off and you're dealing with founders who are just getting started, looking at raising their first rounds. What do you believe the key guardrails need to be, and what are you seeing at this point in time with the people that you work with?
So actually, in the early stage, if you look at the most important elements which we kind of emphasize with founders, is that have good documentation and good understanding on the roles and responsibilities of founders, right? As well as the separation of management and control in the company. I think that is, again, could lead to a lot of conflicts in the long term if you don't have the right expectations set as you are starting to build out the company, right? And that could also mean that who is accountable for ensuring that at the end of the day, if there is a gap in governance or compliance or the way the company is being set up, who is actually being held accountable. You can't have a group of people who hold accountability. It has to be one person who holds that accountability. And again, like I said, Shireen, I think founders in their hurry to build companies sometimes try to say that, I will look at this later once I have raised my funding round. I want to first go build the business. While that's a perfectly good approach to keep a laser focus on the business, I think it's important to ensure that, just those basic hygiene of the business is set up, right? Like just getting a good finance controller, or not a CFO, but more like a finance person who can actually start to define the processes of expense management, define the process of approvals for financial controls within the company, right? As well as communicate that to employees, just like what Abhiraj and Ananth said. At a later point of time, you do need those guardrails, but I think it's also important to start setting that value system and culture within the organization for approvals, right? And again, these are very simple, basic sets of processes which young founders can follow.
Yeah.
Because there is a lot of open source information available. There is a lot of information available in what are the first 5 things you should do when you start a company. And I don't think that the lack of information should be an excuse for founders saying that, I kind of overlooked this entire thing. That is one. Second is, of course, whether you have raised funding or not, I think it's important to have a board in place, right? Have a set of advisors who will help you again take the long-term view on your business. I think sometimes we unnecessarily focus on funding and make that a reason why we will put governance in place. I think governance is required for any good business to start building up, right? Because as a founder, you're again looking at building a long-term business, looking at building value long-term, and you want to ensure that you have the right foundation for that long-term, right? Because your integrity, your intent should not be questioned when the business becomes big.
Absolutely. A good business or valuation will chase a good business. It shouldn't be the other way around. Abhiraj, Ananth and Shanti, thanks very much for joining us here on this special edition of Young Turks. We will take a break. There's a lot more coming up. Don't go anywhere. We're back in a minute on Young Turks with more.